Hi, this is Jack from Alpha Charts with a State of the Market video. Today is August 30th, 2020. Before we get started, this video is for educational purposes only. These are not recommendations to buy, sell, or hold any stock or security. And I may hold positions in some of the equities mentioned. Know your time frame and risk tolerance. Also, if you like these videos, please like and subscribe to my YouTube channel. And I am on Twitter, posting charts pretty much every day. At Alpha Charts 365. So I want to talk real fast on what the purpose of these videos. And really it's to determine the health of the market and to see if it's an investable market. And then secondarily, where is some of the strength showing in the market? So it's not really, specific trading, buy this, don't buy that type of thing, because I don't do that. But this is more for health of the market. So starting with the SPX, as we always do, you can see that it is now back to all-time highs and moving higher. All the moving averages are aligned and moving upwards, and everything looks great on the SPX. So the counter argument would be that the equal weight hasn't broken out above the June highs yet, and is still way below the all-time highs. And I guess there's something to be said for that, right? I do like how this is curling up here. There's very little give back here. Came down to 23-day EMA and bounced right off of it strongly. So, so then the next question is there a catch-up trade to be happened, right? A broadening of breath per se. So let's look at the breakdown of the S&P. So here are the companies that make up the S&P, the largest weights, right? They don't give us the exact weighting, but it's familiar faces: Apple, Microsoft, Amazon, Facebook, Google. And if you see information technology is 27.5%, then healthcare, discretionaries, communications, financials, industrials, right? So it is obviously very information technology heavy on the S&P. So what could cause RSP to just catch up? Well, it would be this area to start to outperform. In communication services, that's Google and Facebook basically right here. So financials, if industrials, healthcare, discretionaries, all those really start to move higher, and these either move higher too, but at a lower rate, or move sideways or down, then we can see the RSP really start to catch up and outperform. So it's something that I'm watching for. We're not seeing it yet, but it can happen. And especially if this kind of retests its breakout, which is very possible, that could be that rotation that would show an increasing in breadth, yet the S&P maybe is chopping around sideways after the breakout. Well, that's one possibility. Now looking at the Qs, now the Qs have established this beautiful channel, and it has hit the upper and lower rails numerous times, and so far it has held. It's at all-time highs on a closing basis, and the moving averages are all aligned beautifully. So everything looks wonderful in the Qs. The steepness of this channel, that may be something that could be a somebody could point to, but in the end, for things to go bad in the Qs, this bottom rail will have to be taken out, and these moving averages will have to be crossing and starting to turn down. And we don't see any signs of that at all. So the Qs look pretty good. Looking at what makes up the Qs, where the Qs are 48% information and 19, almost 20% for communication services. So we're looking at almost 68% between the FANG stocks for the most part, right? Looking at the holdings, Apple, Microsoft, Amazon, Facebook, Google, there you go, and Tesla, Nvidia, Adobe, PayPal. So you see how 68% is technology based, kind of, and you're seeing no financials in here, a smidge of industrials. So again, if that rotation does happen at some point in the future, we don't know when, I could see the Qs. It doesn't have to come all the way back down, right? It could just be sideways motion. It could be a retracement of part of this, but that is a possibility. Now, looking at the Qs versus the SPX, right? And let's go to line chart, get rid of volume. And so I thought this was interesting. Let's just go to weekly, make it easier. Here's the weekly. All right, so here's the 2000 highs, right? And we are just now getting above the 2000 highs. So this is a place where if some supply, some retracement, some resistance wants to pop up, it's a possibility. So I'm watching this chart pretty closely to see how the ratio reacts. Right now, everything looks fine. Everything is moving in the right direction. This trajectory angle is very steep. Reminds me more of this type of angle. Not saying that we are in a 1999 or 2000 scenario, but it is very steep. And as this shows you, it could keep going. I kind of hope it doesn't. I hope there is a retracement here, just because this led to that. And so I'd rather not see this. So I wouldn't mind to see it kind of chop around and retrace a little bit right here. You see, the smaller version was right here, and again, it did chop around, and there was a pullback right there, retracement. Something like this, and then it kind of pulled back, retracement, and then continued higher. Or this whole thing, and then chopped sideways for a while. So that would be the safer thing for it to do. If it continues higher, then I'd be more concerned of an outcome of this and then that. We'll see what happens, but it's just definitely something I'm watching for on a risk on, risk off right now. I mean, it's healthy. There's nothing wrong with it, but we'll see how parabolic this wants to get or doesn't. Again, it's a ratio chart, Qs versus the SPX. IWM, going back to the daily and candlesticks, you can see that we are above the June highs, but below the all-time highs, right? And this was an area where it's at, where there was past resistance. So let's look at the Russell for its constituents. Okay, so you see it's healthcare. By the way, it's an equal weight index, so there isn't anybody that's really a heavy hitter in here. And as you can see, it's healthcare, financials, industrials, right? Then infotech and discretionaries. Everything else is much less after that. So these are the 5 that are going to really move it. And so if 2 or 3 start moving it, you may see the Russell start catching up. Again, there's your financials, there's your industrials, there's your discretionaries. So there is a scenario where SPX and the Russell start to outperform the Qs if we see rotation into those 3 sectors, which the NASDAQ has very little exposure to, right? The discretionaries is 20%, but then healthcare is only 6%, and financials don't show up, right? So that is the scenario that S&P and especially the Russell, the small caps, really start to outperform. We're not seeing it yet, but there is that possibility, especially where the Qs are and how much they've run. Let's look at the next chart, which is XLF financials, right? So that's where we think we may see some rotation, and it is constructive, not above the June highs yet, though. So we do want to see that, but moving averages have all turned back up, and things are looking not too bad for the XLF. Looking at it versus the SPX, you've seen this chart. Helps if I type it right. It's got a falling wedge type pattern in it. It's definitely something I am watching. It has not made that turn higher yet. Has not made that turn higher yet, but there is a momentum divergence that's emerged here. It's a beautiful pattern, and it is right at the spot of the past low of this ratio chart, which is 2009 financial crisis low. So all this is setting up for financials to rip. It hasn't happened yet, though, but it's definitely something I am watching. A little side note and full disclosure, I bought just a handful, not many at all, XLF calls into December, end of December, because I don't know when or if this is going to happen. So I understand that my risk will be the cost of the calls. So I kept it small, and I don't know the timing. So I went further out. I gave myself to the end of the year for this move to happen. We will see, if this pattern is correct, then, by the end of October or beginning of October, we should see the move, but I don't know. So we will see about that. Next up is going to be SMH. So semiconductors, back to candlesticks. Very steep trajectory right here, but still moving higher above all moving averages. We don't know how high this will go. It could go on for weeks or months more for all we know, or tomorrow it could violate all this. But right now it looks healthy and it looks good. So there's no reason not to be in SMH or in technology overall. XOK looks, amazing. But again, see how it's going straight up now? I mean, it was pretty steep here, and now it's even going even faster, steeper. So again, that is a pullback here, maybe in the cards at some point in the future. So that's technology ETF. Again, SMH moving higher, lumber back to a very important level. This is held as resistance multiple times in the past. So we may see it hold again. Chopping around here would make sense, kind of, and then a breakout. That'd probably be the healthiest things for lumber. Lumber breaking out here is the bullish scenario, continuing higher. A pullback may be more of a bearish scenario for lumber. Looking at SPX versus the TLT. Again, it's just a risk on, risk off indicator. And right now, risk is on. There's no doubt about that. People are piling into stocks and not bonds comparatively. TLT. Again, TLT just shows it, how TLT is moving lower, right? Lower high, lower low. So, people are not interested in bonds right now. And as you expect, the 10-year yield has risen. I think that this is a healthy range for it to stay in. And we'll see if that continues. I think if it gets above 0.91-ish, I think that would things could change a little bit. But as of right now, staying in this, this range right here would be fine with me. High yield bonds, are making higher highs and higher lows. So I think that's a bull scenario. And I think, it can easily get up to this 88 level, 88.5 level. I mean, that's been an important level in the past. Let's see what else we got. Bond spreads. So this is IEI versus HYG. And you can see spreads continue to tighten, which is healthy for the market. Unless we see, if this area holds and we pop back up, especially above this 1.66 level, that would change my mind about things. But as of right now, everything looks pretty healthy. And again, it's lower highs being shown here. I'd love to see definitively this area be taken out. We haven't seen that definitively yet. A little pop below right here, but I don't really count that. It needs to really take it out. But they are tightening. Moving averages are moving down. It's all moving the right way. The VIX below 25, and I like 24.5 better. So we are seeing that area. It's at 23 right now. So as long as we're more of a trending market, I think that's good. No major spikes in the VIX. So nothing to see there. Put call ratio, things are frothy. There's no doubt about that. Frothy as far as exuberance in the market. And we're seeing some really, really high levels. Again, this is equity only. So it's not talking about hedgers or anything like that. This is equity only put call ratio. And it's pretty frothy. So a sharp pullback doesn't mean the market's going to, top or go all the way down. But I think that could be a possibility. And just to give you reference, here's the weekly put call ratio. On a closing basis on the week, I mean, we haven't seen, this type of exuberance. There's 09 again popping up, right? December 09, August 09 was pretty exuberant. looking at '07. That was pretty exuberant. So, and that's as far as this goes back. So, put call ratio saying that eventually there's going to be a snapback at some point. We just don't know how far it can go. It can go further, right? It can go further. We just don't know how long. It could be like, again, there's '09, looking some similarities there, right? But you see, it can go further. All right, and then let's look at the value line geometric index. Everything is, again, rotating back up again. Everything looks pretty good, especially on a breadth basis. I think things are doing well, but as you can see, it has not taken out the June highs yet. So that's definitely an area that we are looking to take out. Very similar into in the XLF, right? I believe it's XLF that had not taken out the June highs yet. Similar looking chart. All right, so that was value line geometric index. Leave on the cues. A couple other things I wanted to show you. Here is the fear greed index. Again, just more of a sentiment. 78 into that extreme greed level. Can it go more? Absolutely. And we've seen it go even more. It could get into 80s and easily 90s before things start to correct. And this channel breaks, we could go much, much higher as far as this channel goes. So I don't think it is something that I would be too worried about yet. Everything looks healthy. There are no signs yet of the market cracking. So why not, in my opinion, be long and be strong until we see those cracks happening. They're just not there. Obviously, I'd watch the leaders. That's where you're going to start seeing the cracks happen, right? There's Apple looking really, really strong, just kind of consolidating up here at this point. Here's Microsoft, going literally straight up. There's Amazon, and again, this is consumer discretionaries, right? This is not this is not infotech. So again, looking strong. Look at Google, looking strong, right? Facebook, probably the weakest of the bunch. Still looking pretty doggone strong. Look at that, beautiful. Look at Tesla, looking strong. So I think those, if you start watching those, you're going to get a lot of context on what's happening in the market. So that's what I have for you today. Hope you all stay safe out there. Again, we'll ride this market until it shows us signs of breaking. Trade them well. If you're going back to school this week, good luck at school, everybody. Take care.